Over the last 10 months, the Reserve Bank of India has hiked the policy rate to tame high inflation. Naturally, the government's borrowing costs have gone up as well. Perhaps the government was not expecting a recent blowout in money markets, which has had a knock-on effect on an important segment of the centre's borrowing program. Yields on treasury bills or T-bills issued by the government have climbed sharply over the past few months due to two principal reasons: the centre's decision to announce extra borrowing through these instruments in the budget and uncertainty over the extent of future rate hikes, given that India's inflation still remains elevated. T-bills are government securities with a maturity of less than a year, which the centre issues weekly to meet short-term funding requirements. While many credit instruments and certain categories of bank loans are linked to T-bill yields, some of the longer maturity borrowing instruments of the government are also benchmarked to them. These instruments are called floating rate bonds or FRBs, which typically act as an inflation hedge for investors, similar to the Treasury inflation-protected securities issued in the US. They act as an inflation hedge as the yields or returns go up when inflation rises. When inflation goes down, the yields on floating rate bonds drop, implying price gains for investors. Over the last few months, however, the rise in the yield of Indian floating rate bonds has been so sharp that investors have suffered huge losses on their bond portfolios. Recently, the RBI said that accounting for the relevant T-bill yields, the interest rate on the 2033 floating rate bond of the government would be 8.51%, much higher than the previous rate of 7.42%. By comparison, the yield on the regular 10-year benchmark is at 7.31%, much lower than the floating rate bond. In fact, none of the liquid regular government securities are anywhere close to the 8% mark. Based on the RBI's formula, the other two FRBs the government regularly issued last year, the FRB 2028 and the FRB 2034, would also see their interest rates surge. The likely rate of interest for the 2028 bond is 7.91%, while that for the 2034 bond is 8.25%. This is far above the prevailing rates on the rest of the sovereign bond yield curve. In the current financial year, the government issued 30,338 crore rupees worth of the three floating rate bonds. Bond market participants have recently told the RBI that the government should cease the issuance of FRBs in the next financial year, while their inputs were based on the lack of appetite after racking up huge losses in the current year. It seems that from the government's perspective, too, avoiding the expensive option of floating rate bonds would make sense.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.